The warning in 1929, almost nobody saw the crash coming. But one man did, and Wall Street hated him for it. His name was Roger Babson, and he ran a statistical organization that tracked economic conditions for investors and businesses across the country. By the late 1920s, while everyone else was celebrating endless prosperity, Babson had grown deeply worried about what he was seeing in the data. Credit was expanding too fast. Too much money was being borrowed to buy stocks. The market had become dangerously top-heavy, with a handful of companies carrying most of the weight. And the people who actually understood finance, the bankers and the fund managers, had started quietly moving their money to safer ground. On September 5, 1929, Babson gave a speech at the National Business Conference where he laid out his concerns publicly. He warned that a severe downturn was inevitable, and that when it arrived, it would be devastating. The financial press tore him apart. Irving Fisher, a Yale economist who was considered the leading financial mind of his generation, responded by assuring everyone that stocks had reached a permanently high plateau. The good times would continue indefinitely. Less than 2 months later, the market crashed so hard that it took a generation to recover. Fisher was financially destroyed and never rebuilt his wealth. Babson walked away richer than ever because he had prepared for exactly what happened. What most people do and realize is that Babson had identified a specific sequence of warning signs that always appeared before major crashes: credit explosions, market concentration, institutional selling, liquidity problems, and finally, some unexpected shock that sets the whole thing off. This wasn't theory. It was a pattern he had observed repeating throughout financial history. And that same pattern has appeared before every major crash since, including 1987, 2000, and 2008. We're going to walk through each of these stages and examine where things stand today. The 5 stages Babson spent years trying to understand why financial panics seemed to follow predictable rhythms. He collected data on credit conditions, tracked how money flowed between different types of investors, and paid close attention to what the largest financial institutions were actually doing with their capital, rather than what they were saying publicly. Over time, he identified 5 distinct warning signals that consistently appeared in sequence before major market collapses. The first signal was excessive borrowing spreading through the economy. The second was a dangerous narrowing of the market, where gains became concentrated in just a handful of assets. The third was a divergence between what institutional money was doing and what retail investors were doing. The fourth was a gradual tightening of credit conditions that often went unnoticed until it was too late. And the fifth was an external shock of some kind that exposed all the hidden weaknesses at once. Babson understood that these stages built on each other. Excessive debt made the system vulnerable. Concentration magnified the risks. Smart money, heading for the exits, meant fewer buyers when trouble arrived. Tightening liquidity meant less cushion to absorb losses. By the time all 4 conditions were in place, the financial system had essentially become a powder keg. Whatever came next, whether it was a scandal or a bank failure or a political event, would be enough to set things off. This framework has proven remarkably consistent across different eras and different types of crashes. The names change, the instruments change, the specific assets at the center of the mania change, but the underlying mechanics remain the same. Debt builds up, risk concentrates, insiders quietly exit. Liquidity evaporates, and then something breaks. Stage 1. The credit explosion. The foundation of every major crash is laid years before anyone realizes there's a problem. It starts with borrowing, and it builds slowly until the entire financial system is running on credit that can never realistically be paid back. During the 1920s, stock speculation became a national pastime. Brokers offered arrangements where customers could purchase shares with a small fraction of the actual price up front, sometimes as little as a tenth of the total cost. The brokerage would cover the difference as a loan. This worked beautifully when prices were rising, which they had been for years. A school teacher could turn a few $100s into several thousand in a matter of months. By 1929, Americans had borrowed so much money to play the stock market that the total amount of these loans had grown to match what the federal government spent in an entire year. People who had never taken financial risks in their lives were now exposed to the same dangers as professional traders. The 2008 crisis grew from similar soil. though the vehicle was different. That time it was housing. Lenders discovered they could extend credit to almost anyone regardless of income, because they were planning to hold on to the loans anyway. These mortgages got bundled together and transformed into investment products that ended up in retirement accounts and sovereign wealth funds around the world. The underlying weakness was buried so deep that most buyers had no idea what they actually owned. Today, the numbers have grown even larger. Outstanding margin loans reached record levels through 2025, surpassing $1 trillion. Corporations have accumulated debts exceeding $10 trillion, with much of that money spent repurchasing their own shares to boost stock prices. The federal government now owes more than $38 trillion, sum that represents roughly 120% of everything the American economy produces in a year. By almost any historical measure, the amount of leverage in the system has never been this high. Stage 2, the concentration trap. High prices alone don't cause crashes. Plenty of expensive markets have continued rising for years without collapsing. The real danger emerges when the market's performance depends almost entirely on a narrow group of stocks. In the late 1920s, the American public developed an obsession with certain glamour names. Radio Corporation of America became the most celebrated stock of the era, climbing from single digits to several $100s per share within just a few years. The technology behind radio was still mysterious to most investors, but that didn't stop them from pouring money in. What mattered was the trajectory, and the trajectory only pointed upward. As these popular stocks soared, they pulled the overall market averages higher with them. But this also meant the health of the entire market had become dependent on the continued success of a relatively small group of companies. Once investors started losing faith in those particular names, the selling spread everywhere. Technology stocks created a similar situation before the 2000 collapse. A small cluster of firms in the hardware and software business had grown so large that their movements essentially dictated the direction of major indices. Investors who thought they had spread their risk across many different holdings discovered too late that most of those holdings rose and fell. Together, based on sentiment toward the technology sector, the 2008 crisis revealed concentration of a different kind. Exposure to complex mortgage instruments had accumulated within a handful of giant financial firms. These institutions were so interconnected through derivative contracts that trouble at one bank immediately threatened the solvency of others. The failure wasn't contained because the risks couldn't be contained. They had been allowed to pool in one corner of the financial system. Right now, a group of massive technology companies represents more than a third of the benchmark American stock index. Millions of people invest in funds that track this index, assuming they are getting broad exposure to the economy. In reality, their returns are largely determined by what happens to fewer than 10 businesses. Each of these businesses currently trades at valuations that leave almost no margin for error. If growth slows or profits disappoint, the selling won't stay confined to those individual names. It will ripple outward through every fund and every portfolio that holds them. Stage 3. The smart money exit, one of the most reliable warning signs before a major crash, has nothing to do with charts or economic data. It shows up in the behavior of the people who run the financial system and the companies inside it. Throughout the summer of 1929, a quiet exodus was underway among America's financial elite. Wealthy banking families had begun converting their stock holdings into cash and bonds months before any sign of trouble appeared in the headlines. Successful speculators who had ridden the boom for years were stepping aside and parking their money somewhere safe. These decisions weren't based on newspaper articles or analyst reports. They came from direct relationships with bankers who understood how stretched the credit system had become. Small investors had no access to these conversations. They kept putting money into the market based on what they read and what their brokers told them, unaware that the most informed participants had already headed for safer ground. A similar divergence appeared in the years leading up to 2008. Well-connected fund managers recognized the weakness in mortgage lending long before it became obvious and positioned themselves to profit from the coming decline. Senior executives at lending institutions were quietly offloading their personal stakes in their own companies during the same period when official statements remained relentlessly positive. By the time the crisis became front-page news, the transfer had already occurred. Risk had shifted from those who understood it best to those who understood it least. Recent data reveals the same split taking shape again. Throughout 2024 and 2025, Executives across corporate America have been reducing their ownership stakes at an unusual pace. For every insider purchasing shares of their own company, many more have been selling. Technology founders who built their fortunes over decades have converted significant portions of their holdings to cash. Meanwhile, inflows from individual investors through retirement accounts and trading platforms remain strong. The composition of who owns the market is shifting, and it's shifting in a direction that has historically preceded significant declines. Stage 4, the liquidity illusion. The most dangerous phase of a financial cycle is often the quietest. Everything looks healthy on the surface, while the ability of markets to handle stress deteriorates underneath. In the late 1920s, American monetary authorities grew concerned about the speculative fever in stocks and began tightening credit conditions. They raised the cost of borrowing and tried to discourage banks from funding stock market speculation. Months passed and nothing seemed to change. Prices continued their upward march as if the policy shift had never occurred. Commentators at the time concluded that the bull market was simply too powerful to be affected by central bank actions. What they failed to recognize was that the support structure beneath the market had been gradually weakening. The buyers who had provided a floor during previous dips were stepping back. Credit that had once flowed freely was becoming harder to obtain. None of this was obvious until October, when a wave of selling met a market that had lost its ability to absorb it. Orders to sell overwhelmed the available demand so completely that prices gapped down without any trading in between. Before 2008, a similar pattern developed. Borrowing costs had been climbing for years, yet asset prices remained stubbornly high. Real estate values held steady. Stock markets showed few signs of distress. Professional observers talked about resilience and soft landings. Then, within a span of months, institutions that had appeared rock solid revealed themselves to be fatally exposed. The market's apparent stability had been an illusion masking severe structural weakness. The current moment carries echoes of both periods. Monetary policy has shifted dramatically over the past 2 years, with borrowing costs rising at a pace not seen since the early 1980s. The central bank has simultaneously been reducing the size of its balance sheet, pulling money out of the financial system. Despite all of this, equity valuations remain near historic peaks. When 3 regional banks failed in early 2023, authorities intervened within days to prevent wider panic. The intervention worked in the sense that contagion was halted. But the conditions that caused those failures haven't gone away. They remain embedded in the system, waiting for the next moment of stress to expose them again. Stage 5, the trigger. Everyone remembers what started a crash. Almost nobody remembers why the crash was possible in the first place. When people talk about 1929, usually point to Black Tuesday and the panic selling that wiped out fortunes in a matter of hours. When they talk about 2008, they mention Lehman Brothers and the chaos that followed its bankruptcy filing. These events stick in public memory because they're dramatic and easy to identify. But focusing on triggers creates a misleading picture of how crashes actually happen. The trigger is the least predictable part of the sequence, and also the least important. It's the final domino, not the hand that set them all up in a row. Consider what actually happened in the weeks before the 1929 collapse. Across the Atlantic, a financier named Clarence Hattrey had built a sprawling business empire through increasingly desperate measures. When his fraud was exposed in September, his companies were immediately suspended from trading in London. Investors with ties to Hattrey's ventures suddenly faced margin calls and needed to generate cash wherever they could find it. Some of them held American securities, and they began selling those positions to cover their losses elsewhere. This activity was small at first, but it introduced doubt into a market that had been running on pure confidence. Once doubt appeared, it spread. Investors who had nothing to do with Hattrey started wondering whether they should take some money off the table too. The selling gathered momentum until it became unstoppable. The collapse of Lehman Brothers in 2008 followed a similar logic. That particular firm failed because regulators decided not to arrange a rescue. But several other institutions were in equally precarious positions at the same time. If Lehman had been saved, the crisis might have emerged somewhere else a few weeks or months later. The financial system had become so over-leveraged and interconnected that a major failure somewhere was essentially inevitable. Which firm actually went down first was almost a matter of chance. What matters about triggers is that they cannot be predicted, and trying to predict them misses the point entirely. The question worth asking is not what event will start the next crash, The question is whether the conditions exist for a crash to happen at all. Where we stand right now. Looking at these 5 stages as a checklist creates a troubling picture of current financial conditions. Borrowing has reached levels that would have seemed absurd just a decade ago. American households, corporations, and government entities have collectively accumulated obligations that dwarf anything seen in previous cycles. The federal government alone has added trillions to its debt load since 2020, pushing total public obligations beyond $38 trillion. Companies have borrowed aggressively, often using the proceeds to buy back their own shares rather than expand operations or develop new products. Individual investors have access to more leverage than ever through margin accounts and options trading. The weight of all this debt relative to the productive capacity of the economy has reached historic extremes. Stock market has become heavily dependent on a small group of very large companies. These firms have delivered exceptional returns over the past decade, which has caused their weight in major indices to swell dramatically. What was once a broad measure of American business has transformed into something closer to a concentrated bet on the technology sector. Retirement funds and passive investment strategies have amplified this effect by automatically directing money toward whatever is already largest. The people running major corporations have been reducing their personal stakes at an unusual rate. Filings with regulators show a persistent pattern of executives selling shares even as they encourage outside investors to remain confident. This divergence between insider actions and public messaging has widened over the past 2 years. Financial markets appear calm despite significant tightening from monetary authorities. Interest rates climbed rapidly, and yet asset prices held firm. This resilience has been interpreted as a sign of underlying strength, but it could equally reflect a temporary disconnect that will eventually correct. The banking disruptions of 2023 offered a glimpse of the stresses building beneath the surface. Nobody can identify the catalysts that will eventually test this system. But the preconditions for a serious disruption have accumulated steadily. What this doesn't mean understanding these patterns creates a temptation to act on them immediately, but that impulse should be resisted. Financial history is filled with people who correctly identified bubbles and still lost money because their timing was off. Recognizing that conditions are dangerous tells you very little about when the danger will actually manifest. A market can remain overvalued for years, while those betting against it slowly bleed capital. Some of the smartest analysts of the 1920s began warning about excess speculation as early as 1927. And they spent 2 years watching prices climb even higher before the eventual collapse. Being right about the destination doesn't help much if you run out of fuel before you get there. There's also a difference between awareness and action. Knowing that risks have accumulated doesn't necessarily mean the correct response is to sell everything immediately. Large-scale shifts in portfolio allocation carry transaction costs, tax consequences, and the very real possibility of missing continued gains if the market keeps rising. History offers plenty of examples of investors who sold too early, watched markets climb another 30 or 40%, and then bought back in at higher prices out of frustration. The emotional toll of that experience often leads to worse decisions down the road. What these warning signs offer is not a trading signal, but a framework for thinking about risk. They suggest that this might not be the ideal moment to increase exposure to volatile assets or to take on additional leverage. They suggest that having some portion of wealth and more stable holdings could provide valuable flexibility if conditions change rapidly. They suggest that assumptions about future returns based on the past decade of performance might be overly optimistic. The goal isn't to predict the unpredictable. It's to avoid being caught completely off guard when the unpredictable eventually arrives. The choice financial crashes don't destroy everyone equally. Some people emerge from them with their wealth intact or even enhanced. Others lose years of savings and spend decades recovering. The difference usually comes down to decisions made before the trouble starts, not after. Most investors operate on autopilot during good times. Money flows into retirement accounts through automatic deductions. Portfolios drift toward whatever has been performing best recently. Assumptions about the future get shaped by the recent past. When conditions are favorable for long enough, people stop considering the possibility that conditions might change. This isn't stupidity, it's human nature. The mind gravitates toward patterns and expects them to continue. Breaking from that autopilot requires deliberate effort. It means asking uncomfortable questions about how much risk a portfolio actually carries and whether that level of risk still makes sense given current conditions. It means considering whether the assets that performed best over the past decade are necessarily the ones that will perform best over the next decade. It means having some plan for what to do if markets decline significantly, rather than assuming that moment will never arrive. None of this guarantees protection against losses. Markets can move in unexpected directions for unexpected reasons. But there is a meaningful difference between being caught completely unprepared and having given some advance thought to how you might respond. The people who navigate downturns successfully tend to be those who acknowledged the possibility before it became reality. Credit explosions, concentrated markets, insider selling, vanishing liquidity, these conditions have preceded every major crash for a century. Whether they lead to another one soon remains uncertain. How prepared you are if they do is entirely within your control.